Today's interview is with Gary Lipsky. Gary was an entrepreneur from an early age. He talks about some of his entrepreneurial ventures early on. He also has directed 3 movies. Think about that for a second, right? But now he's fully focused on real estate investing and talks about why that is, what he likes about it, all that good stuff. So stick around for all of today's interview. As always, like and subscribe on Wrestling with Real Estate, the YouTube channel. Go to the WWRE podcast and give me a 5-star rating and write me a review if you think it's worthy, of course. And I'm looking to speak to as many of you as possible. If you're interested in real estate investing in whatever capacity that is, I'd love to get to know you, see if there's any way whatsoever I can help you. So go to the link in the description down below or go to wrestlingwithrealestate.com and sign up there. I'd love to meet you over a Zoom call and chat some more about real estate. But before all of that, make sure you stick around for all of today's really cool interview with Gary Lipsky. Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we have Gary joined with us. Gary's in the Amazon jungle, is that right? With the forest behind you? No, Gary's in beautiful Manhattan Beach in California. So how are you doing today, man?
Good. Excited to be on.
Thank you for making the time. We appreciate it. Before we dive into the conversation, do you want to tell us a little bit about yourself and your history and what your current focus is right now?
Yeah. I've been an entrepreneur my whole life. I started as a kid shoveling driveways and auto detailing cars during the summer. In college, I started a restaurant delivery service, kind of like a DoorDash now. And then I co-produced 3 independent films in my 20s. And then I started an after-school outdoor ed and leadership development company in my early 30s. And I had been investing in real estate during this time. But when I sold that company, it allowed me to get into real estate full-time. And I leaned on my strengths of managing people, managing money and projects to allow me to succeed in real estate. So I used all those experiences leading up to that point to leverage for a successful career.
Yeah, very cool. So what do you think brought on that entrepreneurial mindset early on for you? Because a lot of kids, they just go to school, play sports, whatever, play computer games, right? They have no interest in other things. What do you think that was for you?
It's funny. When I go back to my parents' home, who still live there, and I see like Wendy's Way book on the bookcase, about the Wendy's chain, and I have other entrepreneurial books. So it was just a bug in me early on of maybe I wanted to be in control of my own destiny, and working for others. You're not going to get that financial freedom. You're not going to get that upside, and it would have been great for me to work for other people, to learn from them. But I didn't go down that path. That was like my one regret, but I'd never regret being that entrepreneur, and that fuels me. I don't mind working long hours and being invested fully into it. And that's what's led to my success. Working for others, I just didn't have the motivation, quite honestly, and I was doing tasks that I felt were mind numbing, and so it didn't challenge me, and so it really excited me to do things on that I had control over, that I was making the decisions.
Yeah, what is that saying? I'd rather work 80 hours for myself than 40 hours for someone else, right? It's just so true, because you're your own boss, right? You get to choose what those 80 hours look like. What was the, out of interest, I'm fascinated. This is really cool that you were such an entrepreneur. What was the most successful entrepreneurial venture as a kid, do you think? Which one was the most successful for you?
Well, I guess the restaurant delivery service business that we had going on, we started it between college break, and like our first day, we had like 6 deliveries. I mean, that, you're not making any money, but we every day was like a little bit more, and we got an article in the newspaper, and then like we ballooned to like 70 deliveries in a day, and so it was starting to really pick up steam. But I had to go back to school. I was contemplating like taking a semester off, and we set some other people up to run it, and we didn't do a good job of setting them up for success and picking the right people, and they ran it into the ground. I mean, we didn't really invest any money into that. It kind of fed itself. So it was a great success, but it was also a great lesson.
Mm-hmm. That's cool though. That's cool that you had the mindset to do that. And then you said you went into doing independent films.
Yeah. So I was writing. I was a PA in some films, but again, I wanted to do it on my own. I was writing a script with a buddy of mine, and coincidentally, I visited a friend that was in Palm Springs that was converting an old hotel into condominiums, and so that I was kind of learning the real estate business then. But I'm like, this would be a really cool place to shoot a video. And so he's like, yeah, you can. And so like 4 months later, I pulled up with a couple trucks and like actors and crew, and we shot a short film. I think it was like 12 minutes long, but from that, we were able to pre-sale to some countries like Brazil and Germany. And so we were able to raise enough money to create a film. And I mean, it was a great lessons on managing your budget, working with people, and making the day. You've got to film what whatever you said you were going to film by the end of the day, because you'd have to move to the next location. And so it's just a great lesson in problem solving and making it work no matter what. And that's really good in real estate too, because you're constantly throwing curveballs. You got to figure it out. You got to be a problem solver. No matter what whatever business you're in, you have to be a problem solver.
Yeah, that's cool that you did that. Did the bug go away? Was there a passion for films, or was it more the entrepreneurial thing coming through again, where you thought you could make some money?
I think it was just entrepreneurial. It didn't go away, but I was definitely frustrated with the business too, because once you make a film, it's out of your hands. You're trying to collect money from different places, and you don't know if it's good or not. I was writing scripts for MTV and Michael Keaton, and you don't know. Again, you're rewriting and rewriting and rewriting, but it'll eventually potentially get made. There's just a lot of things you can't control, and maybe that's like part of my control freak. Like I want to control everything, and so I just ventured into I was writing a script with a buddy of mine, and he introduced me to a school. I was looking to pay some bills, and they said I needed a lifeguard, and I'm like, I've got a lifeguard. So I went out and hired it, and that business kind of grew to over 700 employees and over 500 independent contractors. We were working with over 9,000 students daily. So like I said, like once I'm in something, like I am all in.
I love that though, but that's the way to be, right? You're either all in or you're not in at all, pretty much, right? You've got to dive in with both feet. So then you built that business up, and then you sold that, and that's when after that was the point that you got into real estate for the first time.
I was investing in real estate since 2002. I sold that at the end of 2016, but it allowed me to get into real estate full time.
Okay.
I was looking for an exit, and it gave me time to learn as much as I can. I mean, I'm still learning every day, but I was able to really delve into as many podcasts as I can, read as many books as I could, and go to conferences and network and just build up my knowledge base. And I invested in other people's deals and then started doing my own deals. But I wanted to build up enough body of work so I felt confident to take investors' money and proof of concept too, So I was, trying to learn from as many people as possible so that I can be as successful as possible.
Yeah. I think for a lot of people, speak to a lot of people, that proof of concept is so important, because until you do it, it's just numbers on a screen or a property that you see on Zillow or whatever it is, right? It's until you actually go through and do it and you see, okay, I didn't die, or I didn't, the roof didn't fall out, the sky is still there, everything is fine. Until you get that proof of concept and you get those returns as well, it's amazing how that can change everything with you. So you said in 2002, that's when your first venture into buying was. What did you buy, and how did that come about?
Yeah, so it was a single family home. I just had a kid, and I wasn't looking at a house as, this is where I'm going to stay forever. I was looking for value add. Little did I know that was going to play out down the road, but I had no money down. I had debt, and here I am spending in LA $440,000, and at the time I was like, oh my God, like, how am I spending $500,000, not knowing 3 years, 7 years down the road, that house would be worth, almost 3 times as much, but, we bought in a decent neighborhood that we can add some value, because we knew things needed to be done on the house. So we bought the house, we opened up the kitchen, we turned the garage into an office, and I was able to rent out my office to my business. And so then, we were able to get enough equity to buy another house, and then that turned into a rental. And we added value, and then bought another house. And so that kind of like leapfrogged away. And I was always looking at houses as that, how can I add more value? How can I increase my net worth, for the long term? And then that gave me enough money to start investing in other people's deals as well.
That's really cool, because I'm sure back then there wasn't a lot of bigger pockets, online stuff everywhere. We're lucky these days that there's a ton of information everywhere. But back then, that was just instinctual, or had you read some stuff, or did you have some kind of mentor or someone guiding you?
Yeah, just little things I was picking up, but just kind of looking at my financials and just wanting to, like, how do I increase my net worth, and what are the ways? I mean, certainly if there was those things, I could have provided more rocket fuel and be a little bit more intentional, because this was a slow process, but it gave me the confidence. It gave me just enough to keep going, to build that, to spark that interest, to realize, wow, I really like this. I like that creative side of looking at something and seeing, how can I take this nugget and turn it into gold? And so it evolved over time, because my family really wasn't investing in real estate. So it was just other things I was learning from other people. I wish they said invest in real estate. I wish they did,
Yeah. That's cool. I imagine you're obviously a creative person, right? You don't write movies and direct movies and put this all together without being a creative person. I'm sure that creative side helped you when you were buying properties, because maybe you could see stuff that other people couldn't see as well. I'm sure that helped you. So then you got to the point where you sold your business. How many single family homes did you own until that point?
It was only, I only had one at the time, but it was very expensive. So I was doing really well off of that. So I'd rather, even when I do some high-end flips now, but I'd rather have, it's kind of like multifamily, where it's like, just have one big asset versus lots of little ones. So this one was supplying I didn't have to take up much of my time, but it was giving me returns of if I had 10 small single family homes elsewhere.
Wow, cool. So then, once you sold your business, it was multifamily that you were after, or did you not know at that point? Were you intentional at that point? Or did you know what you were going to get into?
I got my real estate license. I wasn't sure, but as I was spending more and more time in looking at the various real estate opportunities, I focused on multifamily. I felt that was geared towards my skill set of managing a team and managing a business, versus smaller stuff. But it did take me a little bit. And when you first get into real estate, there's this kind of squirrel mentality. Everything sounds really cool. All the different asset classes, and everyone's selling their product or training program. But multifamily seemed that it was the best fit for me, and I love it.
I absolutely know what you're talking about there, because I've been so guilty of that, the shiny object syndrome. Even to this day, I still fight it, because you listen to someone, there's someone doing something in all aspects of real estate, right? Every niche of real estate, there's someone killing it and making it sound like it's the easiest thing in the world. So I'll listen to a podcast about someone doing something and I'm like, wow, that's a low hanging fruit. I can go do that. But then I realized, no, you've got to focus, because even though there's one person being amazingly successful, there's a ton of people who aren't, right, and who aren't creating that. So it's so important to be intentional and to pick a niche and kind of stick to it. And I love as well how you realized that you had a skill set for building teams and bringing people together and working with that, and then finding, multifamily that works with that, right? Yes, you need a team with a single family, but it's not, it's not on the same scale, nowhere close. So I think that was cool that you realized your skill set and went after that. So what was your first venture into multifamily? You said you'd done some passive investing as an LP right before that. Was that many moves before, or was that after you sold the business?
Right around then, because I had some liquidity.
Okay.
So I invested in some student housing in Tucson and a couple other bigger multifamily deals in DFW. I was a key principal on a deal, and that means, I signed on the loan, but I was able to get, I wasn't considered a GP, but I was able to, get underneath the hood of someone else's deal that I trusted and I liked, so that I can learn and ask as many questions as I wanted to. And that gave me the experience to sign on a loan for my own deal, an agency debt. It was I believe it was a Freddie loan. And so the next time I wanted to do a loan, they had underwritten me. They felt comfortable, even though I didn't do that much on that deal. It gave me clout with the lender.
But for people who don't know, what is a key principal? What is their job on the deal?
Yeah, and it's funny, the lending environment doesn't look at it as a key principal, but it's a kind of term that some of us use, and you bring, the sponsorship team needs a certain amount of equity invested in the deal, and quickly you start running out of equity the more deals you do. So I invested $100,000 in this deal. I signed on the loan, and so I was giving some liquidity and net worth that the sponsorship team needed, and in return I got again experience with the Freddie loan, and then also behind the scenes stuff. But the lending environment, they don't look at it as necessarily a key principle, but definitely people within the industry, we kind of talk about that as a good way to get your feet wet, to learn.
Yeah. And being passive is a great way to learn as well, to start off with, right? For so many different reasons. For one, you're getting a return on your money, so you're not necessarily paying someone. Okay, right. You're not getting the same level maybe, but you can create friendships with a GP, and I'm sure any GP that you invest money with, right, they're going to answer your questions if you have some questions or whatever, because you're giving them money, you're giving them what they want. Now, of course, you can be a time Dracula, right? You can be sucking all their time dry, but they'll answer some questions. But you're also seeing what they're doing, like what kind of deals they're looking at. How are they reporting? What kind of underwriting they're doing? Stupid things like you see what a K1 is, right? A lot of people, until they invest passively, might not know what a K1 is and see what's on a K1. You're learning all this stuff. Meanwhile, you're getting a return on your money, hopefully, right? If the deal goes well. So I think it's such a great way. Even, yes, passive investing is great for certain people who don't want to do anything, but even if you want to be active, it's a great stepping stone. And also, you can kind of use that as experience on future deals as well. It doesn't count as just experience. A bank's not going to look at you, you're a passive investor, okay, you have all this experience, but you have some experience, which is going to help. So I think that's a cool stepping stone, and that you use that to get to your first deal. So maybe talk to us about your first deal. What was your first deal, and how did you go about it?
Yeah, so it was a 42 unit, bought in Tucson, and we raised $1 million on it. We found it. My business partner was going out there, and the broker called him up and said, "I just got keys to this 42 unit. You'd be the first one to see it." And so that gave us a leg up. It was a bit of an ugly duckling, and that's a good thing, because not too many people were excited about it. So we were able to get it at a really low cost. and it just needed a little love, quite honestly. It looked like an old kind of motel. Horrible. It was called Townhouse East, and didn't look like any townhomes I'd ever seen. Um, and it was a bad name. We rebranded it Midtown on Second, so it had a kind of a cool hip name. Painted the whole place, changed out. They had these sliding glass doors as their front doors to the unit, so we changed them out to French doors. And so just that, 130,000, something like that, we spent on that facelift, dramatically changed the property. Most of the tenants that we thought were going to move out, because their rents were so low, they were 50% below market. And they stayed with a higher rent bump. We moved some people up from 400 to 650, 700, and they stayed because they loved the look of it, and they knew that it was still a great deal to be at this place that was centrally located for still such a low rent. We've raised the rent 7 times, twice during COVID, because the demand, quite honestly, and we've kept it full for the most part. So we have had an offer already after a year. We hit our 6-year sell price from someone. It did fall out of escrow. We've got another offer that's come in as well. We'll see if it makes it to the finish line now. But if not, I mean, we're happy to hold on to it. It's throwing off a ton of cash. So, we underwrote it super conservatively. I mean, obviously quite honestly, we were nervous on our first deal. We didn't know how it was going to play out. So, and we just underwrite super conservatively always, because there are going to be curveballs. You don't know, what's going to happen. And most of the things played out great for this one, but you don't know on other deals, you are going to hit some setbacks. So it's just nice to have those buffers so that you can under promise and over deliver.
Yeah, so true. That sounds like a great deal. Congratulations on that. You talked there about underwriting conservatively, right? We see that all the time. We hear that all the time, right? It's kind of a buzzword almost. Who doesn't underwrite conservatively, right? It's like, but what does that mean to you? I'm sure it means something different to everyone, but you guys say that you underwrite conservatively. What does that mean so people can maybe understand how you guys look at it?
Yeah, that's a great question, and a true statement. Everyone says, "Oh, we underwrite conservatively," but I mean, so in Tucson, you're getting, up until COVID, you're getting 8% rent bumps a year. Obviously, we can't underwrite to that and expect that. So we, whether it's 2%, 3% rent growth over time, we'll always, have very low income growth the first year, because it takes time to implement the plan. Now, in our case, it happened right away, but usually that's not going to happen. And certainly on a bigger property, it takes more time. So just monitoring that income growth over the T12, and we won't do more than 10% typically over the first year. And now, based on the economic cycle, we'll usually underwrite to like flat income growth, or just 1 or 2% depending upon, and then maybe zero. Right now we're underwriting to 0% rent growth year one, maybe 1 or 2 in year 2. We'll also do a lot of the play is burning off loss to lease, so just focusing on that. When you're doing increased other income, if you're adding washer dryers, if you're adding carports, you obviously you can't take that money all up front. And I see a lot of underwriting, they do that because it takes time. One, you've got to get that stuff installed, you've got to implement, and so maybe it's 50%, maybe it's 25% the first year that you're gonna get that other income, but it's gonna be and really in future years you're gonna capture all of it. Also, if you're adding low flow toilets and low flow shower heads, again, you might underwrite it to getting maybe 25% of that savings in year one, and then the rest of it you're going to gain in year 2, because it does take time to implement and whatnot. So you just can't grab it all in year 1 and expect, you're going to nail it.
Unless you're looking at the broker's pro forma, right? You can sell 100 units in a year, according to them, so that always makes me laugh. That's cool. So it's cool also that you had a partner, right? Maybe talk to us a little bit about how did you find a partner, and what are some good things to consider when trying to find a partner, because that can be challenging in itself.
Absolutely, and that's a key thing to my business at Rocket Fuel, because when I sold the other business, as an entrepreneur, I had the mindset of not wanting other partners because most of them don't work out, quite honestly. So, I was looking at 12 units, 16 units, and I was doing it by myself. And then I met Kyle. We were going to the same meetups for a while, and he was going out to Phoenix. I was going out to Phoenix. So we decided to go together. And these are long days. I mean, 5 a.m. to midnight. So you really get to know someone, get to understand their work ethic, their values, what their why. And we definitely clicked, and it was great to share ideas on a property of what I saw, what he saw, what our numbers were, and they were similar, and just bounce ideas off each other. And it provided each of us with a lot more confidence in going after a deal, because we were seeing the same things, and we knew we can rely on each other. So raising $1 million of other people's money, we felt a lot more comfortable. We were able to break up some tasks. So that's definitely led to a lot of growth in our business. And so we're on our next deal, we leapfrogged that. We took down a $15 million deal. And with some other partners, we raised $5.7 million. And that wouldn't have been possible if we didn't partner up.
Yeah. Well, you touched on it there, the raising money part. How hard was that raising money part? Because did either of you, I know you didn't necessarily have experience in multifamily apart from some single family stuff and the passive investing. Did your partner have any prior experience?
No, none at all. But he was super diligent on preparing his investors beforehand. And talking to them on a consistent basis, sharing case studies. So they were primed and ready, and you don't know how much money you can raise until you do it. And, it sounds cool, but it's tough because, people will say that they're in and then not deliver, or, there's a lot of things that happen. So you've really got to make sure you have a big pool, because you'll be surprised. Some people that said that you thought for sure we're going to invest don't. And then other people come out of the woodwork that are all in and want to invest, and you never would have guessed that they wanted to. And the only way to find that out is by talking about what you're doing. Yeah.
What were some lessons you learned on that first one from raising money from that?
Keep your network, involved in what you're doing, sending out that newsletter. I didn't do a good job of it. He did a better job of just priming them, getting them ready. And it's, when you don't have a deal, it's like hard. You're like, well, I don't, what am I talking about? And share articles, share what you're doing. It's so important to just to prime that investor database and educating them, because a lot of people don't know, have never heard of what we're doing, multifamily real estate. That's so risky,
Yeah.
Financial advisors will tell, their clients, like, don't do that, because they don't get a fee. So you've got to spend that time educating your potential investors.
Yeah. What's amazing outside, because I'm sure you're like me, we listen to podcasts all day, read articles, talk to people in the business. So we're in and around it all day. But once you kind of get out that bubble a little bit, it's amazing how little and how scared people are of real estate, right? How little they know and how scared they are. And they just, like you said, it's that misunderstanding, that complete misunderstanding of what real estate is. So you said that you guys were priming your investors. Do you guys have a big email list? And how were you building that email list? How were you finding these people to start off with to keep priming them?
Yeah, so Kyle had a meetup And then he started a podcast as well. And then I started doing a meetup in downtown LA, and then we both of us started a meetup in Phoenix, because we were going out there so often looking at properties, building relationships. So we're like, we're already out here. Let's continue to meet other people. And then we also started doing a podcast on Friday, and then just recently we did the virtual asset management summit. So it's building your brand, putting yourself out there, and you gain a little bit more confidence each time. So you don't expect to be perfect from day one. I certainly wasn't, and still far from it. But each time I get a little bit better and a little bit better. So you've gotta be out there. Going to conferences, I'd come home with 75 business cards, and you've got to follow up with these people, and most of these people won't invest, but all it takes is one or two people to invest, and it's a successful conference.
That's interesting. That's an interesting topic in itself there, the conference. So you said you came back with 75 business cards. Is that a case of trying to meet someone quickly about, hey, what are you doing, and getting a business card, or do you spend more time than that to get the business card? How do you see networking in a conference, right? Because it can be challenging.
Yeah, so I much rather depth versus width,
Mm-hmm.
So I joined the group, the Sunrock group, and so that they're very big on networking, and people know the drill. They come with their business cards, and we're sharing, and you're meeting people, and you're figuring out what markets they're interested in investing in. Do they want to be a GP? What do they bring to the table? So ask a lot of questions. And what I would do is bring a pen and write those notes on the business card, whether, maybe after you've just spoken to them, because it's so hard to remember, and you want to have that personal touch.
Mm-hmm.
So jot down as much information as you can about that person, so that you've got that camaraderie. You're building something, and it's not just, hey, you meet them once and then invest in my deal, because that's not legal. And two, it's just you're not going to get anywhere.
I like that. I like that piece of advice. It makes a lot of sense because, like you said, how many people you meet in a day in a conference, right? A lot. Especially when you're trying to remember something personal about it. Take that 30 seconds, what it is, and write something down. I love that. I'm gonna steal that and keep it for myself. So then you guys went to a bigger deal, right? What was the size of this deal? If you guys are raising, you said 5 million for this one.
Yeah, 5.7. It was, we went from a 42 unit to 128 unit.
Okay.
And we got this deal because our partner on the 42 unit, he came in for some net worth and liquidity. He got the deal from the broker, and he had a full-time job. He didn't have an opportunity to look at it, but we looked at it immediately. We knew it was going to market on Friday, and this was a Wednesday. So my business partner texts me. He's like, "We're going to Phoenix tomorrow morning." I'm like, all right. So we left, I don't know, like 5 a.m., 4 a.m. We were the first ones there to see it. We walked the property. We really liked it. We walked the comps. And, we had a rough underwriting beforehand. So on the drive back to LA, we were just, underwriting it, the whole way, making, just fine tuning it. And we thought that this was right in our wheelhouse as far as what we, the kind of property we were looking for. It was just a matter of, okay, stepping up to this bigger deal. So we immediately, wrote an offer and got it under contract before it went to a best and final. When it goes to a best and final, 9 out of 10 times you're going to lose because someone's willing to pay more. Again, it's that conservative underwriting. We're going to have a more conservative reversion cap. We'll get beat almost every time on a best and final. So we wanted to beat them to the punch. So we put in an offer that we could live with, and that that was worthy enough for the seller. And it's funny, our broker always tells us, you've got to be uncomfortable enough, with the price point to get the deal. And it was right there. Obviously it's a daunting task to go from, raising 1 million to 5.7, but we talked to a few other partners that we knew that we had relationships with, and said, hey, do you want to come on board and take this down? And quite honestly, we did get a lot of no's from people. Eventually, we found the right team. Maybe people were maybe involved in their own deal at the time, or they didn't know the Phoenix market, whatever it was. We definitely did get some no's, but we kept positive and we kept pushing, and we got the players, and we got it done.
I'm interested in, you talked a little bit about how you got people involved, but that was after you guys had the deal under contract, right? So to go after this big deal to start off with, maybe talk a little bit about what your mindset was, how you were able to have that confidence to go do it. Because it's one thing to buy a 42 unit, right? 42 units is not a small property by any stretch of imagination, right? For most people, they couldn't even dream of owning a 42 unit, but to go from a 42 unit to 100 plus units, it's a whole different animal, in my opinion, right? It's a big jump, and the money raising is one thing, but there's a whole level of complexity and sophistication added to that, right? Maybe talk a little bit about your mindset, because for some people, they can't even imagine buying 100 plus units, and I think it could help some people for you to talk about how you were able to do that.
Yeah. So the scale didn't scare me. I mean, again, as being an entrepreneur my whole life, the size of my teams, the size of the budgets I managed, the size of the projects. So that wasn't intimidating at all. It was finding the right partners, to get the deal done. And we knew we'd eventually get there, and we felt comfortable in our asset managing. We didn't have the first deal that long until when we found this deal, but we felt comfortable. We were doing a good job. We had everything in place, so we thought that we could be successful going bigger and have much more economies of scale. And we had been going after some other deals before and did not get them. So it was just a matter of just thinking big and saying, well, why not us? We knew other people that were doing it. So that's been my mindset for a long time. Why not me? Why can't I achieve that same success?
Yeah, I love that. It's just such a great way to think. Why not me, right? Because there's other people doing it.
Yeah.
There's other people taking down the deals bigger or same size. It's someone is doing it, so why not be you? So I love that mindset. It's such a great mindset. Tell us a little bit about the deal. Why did you like the deal? What was the opportunity with this one?
Yeah. First off, branding, it was called La Casa. So it was geared towards one demographic. So we changed the name to East 3434. Again, kind of a cool name. It just a lot of the units weren't upgraded, so we could upgrade the units. It was in a great part of Phoenix, C-class neighborhood, but there was a lot of movement from the neighboring areas that were improving, and this was going to turn into a B-class neighborhood. They're essentially located near the freeways. They had their property management company focused on smaller properties, and this was way out of their league. They didn't have the systems in place. Nice people, but this just wasn't their sweet spot, and so we knew that we can come in and greatly improve that. And then washer dryers. They didn't have washer dryers, and we knew that we can get a $75 rent bump by installing them, and adding some amenities. So we added a dog park. We added we painted the place. So the different things to add a lot more value, so that we can boost our NOI at the end of the day. Yeah.
Well, did you guys have any challenges with dealing with brokers, with dealing with a broker on that deal? Because obviously you guys do have a 42 unit, but again, going bigger and buying a $50 million deal, raising $5 million, it's a different thing. So did you have any trouble gaining that credibility, or was that not really an issue?
That's where team comes into play. So our other partner had done a deal with this broker before. Again, smaller unit. Building, it might have been 28 or 32 units, but he had a relationship with the broker, And so that, greatly helped us. If we didn't have that relationship with the broker, we could have felt, an uphill battle on that. But because of that relationship, it helped us.
Cool. And when did you buy that recently? When did you guys purchase?
So we bought that in November. Almost a year.
Okay.
Yeah.
How are things going with that property?
It's going good. We definitely faced some obstacles, because we barely had implemented the business plan and COVID struck. So we hit, a little bit more crime than we expected, a little bit more delinquency. We're just slightly off plan, which is, considering COVID, we're in great shape. We have, over $1 million in reserves because of, the cap. We haven't implemented as much CapEx as over time. We're waiting on washer dryer permits, which we started before we even bought the property. So we have a lot of capital reserves. So not that we were worried, because every month we've hit above our break-even point. So it's going well, not as well as we had hoped so far, but each month we're increasing the rent per square foot month over month, which is great to see. And each month we're gaining a little bit more cash flow. So it continues to grow, and we continue to do more turns, and add more amenities. And we just finished the asphalt, so that looks really good. We added some more new pool furniture. So each time we're getting, making the property look better and better.
So has COVID changed your business plan at all? Are you guys just still doing it, just delayed it maybe slightly?
So, when COVID hit, obviously, I think like everyone else, we kind of paused for a little bit, kind of got after a month, kind of got a feeling of where this was going. And then we went back and put our foot on the gas. We definitely paused for a little bit. And we just continue to monitor the ebb and flow. And obviously you've got to work with your tenants. So, we discontinued late fees for a while. We found services that can help our residents make it through this time, because it's a give and take. It's got to be a win-win. We want to improve the community, and we've got to be true to our investors. And it's a long-term investment, and we know over time, this is going to be a winner for our investors. So just be patient with us while we get through this time, and then help these people. And, we have a little bit more delinquency now, obviously. But a big picture where, the value keeps going up, the cap rates compressed, we're doing great. So, it's never over till it's over, until you sell. Yeah. But, things are pointing in the right direction.
Cool. That's good to hear. I think COVID is, a challenge for everyone, right? How are the tenant landlord laws in Phoenix? Are they landlord friendly?
Definitely landlord friendly. I mean, there has been an eviction moratorium, but you've got to show proof that you've been affected by COVID. So, you always have a few tenants that are ignoring you or not showing proof, and you can get them out. But most tenants, if they're struggling, will communicate to us, and we can provide resources. We can help them out. So that's been good. It's the tenants that aren't communicating to you that you get frustrated with.
Yeah, I'm sure. With your investors, what kind of return structure have you guys set up? Is there a preferred return? What kind of waterfall? Did you do it the same on both properties as well?
Slightly different. Just on the first deal we did, I think it was like an 80-20 with a 6 pref, and this went to a 70-30 with an 8 pref, and that's really going to be our model going forward. Pretty much a 70-30. We try to hit probably around 8% cash on cash, 15% IRR. Somewhere around there. We didn't do a waterfall yet, but I think going forward we will. Maybe after 15% or 16%, we'll do like a 50-50 split. Mm-hmm. But it's always, the investor gets their money back and gets their pref, and then we start seeing some money. We really don't see anything unless we're successful. And So it's perform, like it's performance-based, agreement. If you don't do well, if your property doesn't do well, then you're gonna be hit as the GP. So you better over deliver so that you can get a piece of the action.
Yeah, that's the cool thing about the preferred return, right? There's an alignment of interest there, right, with the investors. Maybe for people who don't know, actually, that's an interesting. What is a preferred return for people?
Yeah. So if it's 8%, they'll get 8% of their money first before. Some people do a recapture too, but so they'll get all their money back. They'll get 8%, and then we'll go to the split 70-30 or whatever you have it. But so it's like it's a bump for almost like interest, that they're getting on their investment.
Yeah, it means that the general partners aren't getting a penny until those investors get that return. It's not guaranteed, but yeah, I think it's cool. What was you guys' thinking between the two properties in terms of returns? Why did you give a 80-20 6% on the first one and then a 70-30 on the second one?
Overly conservative on the first deal. We just, wanted to nail it right, and so we wanted to get as much profit to our investors as possible. I mean, looking back, we didn't need to be as conservative, and do a 70-30 split and the bigger pref, but certainly they've done really well so far and will continue to do well. But as we got more comfortable, looking at the deals and finding deals that kind of fit this model, it was a better way to go for all of us.
Well, I think with the first deal, it's better to make less money and give the investors more of it. Plus, I'm guessing the lower pref was so that you guys had a buffer, right? So that you guys didn't have to hit that target, so we'd give you guys some room.
And we didn't know how much, to the best of our ability, kind of factored in what the cash flow was, and we didn't want to say 8 pref, and then the cash on cash is 5, and then you're not hitting it. So we wanted something that made sense for the IR, the cash, all these different numbers that you have to like kind of tweak to make a winning formula for everyone.
How important do you think those splits are for investors, or do you think they don't look at that as much as they look at the investors? If you offer a 70-30 8% as opposed to an 80-20 6, do you think that'll make or break it, or do you think it doesn't matter that much?
I think a lot of people key in on the returns of a high RR, like 18% or 9% cash on cash, and I tell a lot of investors, look underneath the hood. Every deal looks great, fancy. Well, typically a fancy booklet and whatnot, but just because they say 18%. What is their reversion cap? You've got to look at the numbers to really see, my deal at 15% IRR and 8% cash on cash may be a much better deal than the 18%, IRR that you're looking at because of my conservative underwriting that is truly conservative and our business plan and whatnot. And, you're betting on the jockey, so make sure, has this person run businesses before? Have they been successful? Like there's a lot of other pieces to it. But yeah, people do get hung up on the IR. They get hung up on the splits, and they've got to do a lot more analyzing to and not just look at those numbers just by themselves.
Yeah, because it's all numbers on a spreadsheet at the end of the day, right? That's all it is. It's not actual numbers. It's, till you get to the deal, you don't really know. And plus, like you talked about there, the reversion cap rate is huge. You can put whatever you want in there, and that's going to massively change your return. And for any people that don't know, the reversion cap rate is what you predict that the cap rate will be at sale, because cap rate determines price. How do you guys come to the reversion cap rate? How do you guys figure that out?
Yeah, obviously it's market specific, and so at the very minimum we'll go 10 basis points above the current market cap rate, and even though cap rates are compressing, we've lost a ton of deals because our reversion cap was just way too high, and in the very beginning we might have been 150 basis points, and just. I wish I had some of those deals back because, I just lost those deals by a couple $100,000, and they'd be home runs because that, the cap rates keep compressing, but doesn't, just because it's compressing now doesn't mean it's going to compress in the future. So you've got to build in the cap rates going up. So at the minimum, 10 basis points a year going up.
Okay, yeah, that makes sense. One last question before I start asking you the wrestling stuff. What, in your opinion, right? No crystal ball, no nothing. Like just two guys talking, right? Where do you see things going? Because there's just all talk about all kinds of stuff. We're October 9th, right? Is there going to be stimulus? Is there going to be stimulus? The election is coming, the eviction moratorium, but then you've got low interest rates and multifamily is attractive for people to come in there. Just your opinion, or what maybe, cooler talk. How do you feel about things?
Yeah, I think, the multifamily is still going to be booming. People always need a place to live. A lot of places lack housing. Cap rates are going to continue to press. People need a place to invest in their money. And I don't think the stock market is going to keep humming like it is. Interest rates need to stay low, which are providing a discount on these properties. So long term, I think multifamily is one of the best places you could put your money.
Yeah, I agree. And I think more and more people are coming into the space because of that. They see that, right? Unfortunately, I wish they would go away, but give us the deals. Cool. Well, as I mentioned, the show is called Wrestling with Real Estate. I like to ask wrestling themed questions, but with your creative background, I think it'll be pretty easy for you. So what would your wrestling name be? If you had to pick a wrestling name for yourself, what would it be?
That's a good one. I grew up in Jersey. I still have that kind of like Jersey attitude, I guess. So something like Jersey G,
Okay.
Something along those lines.
Yeah, the Jersey G. Okay, I like that. Every wrestler has a special move or a signature move. What is your signature move in real estate? What is your strength in real estate?
Asset management, taking my skill sets from all of my previous ventures, being able to manage people, manage money and projects.
Cool, very cool. What's been the biggest body slam you've taken in your real estate career?
Well, we've taken, nothing goes as well as planned. I mean, even on our $50 million deal, I mean, we had obstacles along the way where the interest rate skyrocketed before we had it locked in. When COVID hit, we had an increase in crime, but there's solutions to everything, and we worked around it. And so, whether it's, you had to put a little bit more money in at the time for more security or whatever it is, you problem solve and you get through it. But there are always curveballs in real estate, and you've got to be proactive to minimize it as much as possible.
Yeah, it never goes as planned, right? Ever. Was there a moment you were standing on the top rope getting ready to jump, but you were too scared? What was it, and how did you overcome it?
Yeah, I mean, we were in a best and final on a $30 million deal in Tucson a few months ago. And so that was a big leap for us, and we loved the deal. And if it was around now, we would be all in. An institutional buyer bought it. They added another $1.5 million above our offer, and it was still like a really good deal at that price. But we just didn't have, the guts at that time to really, that was a big jump for us. But now we've acquired a much bigger investment database and some other partners that we can work with. So we would go all in next time. But man, I wish I had that deal.
That's great, though. That's great. That's a great story. Thank you for sharing that. Well, Guy, this has been really fun talk. I've learned a lot about what you guys have done and how you guys have gone about it. It's been really interesting. Before we go, how can people get in touch with you and find out more about what you're doing?
Yeah. Go to my website, aptcapitalgroup.com. And we also have a mastery program for anyone that wants to learn how to become a best-in-class operator. And that's assetmanagementmastery.com. And I'm on social media on Facebook and LinkedIn and Instagram. So just look for me and connect, and let's talk real estate.
Cool. Well, thank you so much, man. Have a great day, and thank you for being here today.
I appreciate it. I had a great time.
Hey guys, thank you for listening to today's episode. I really appreciate each and every one of you for listening to the show. I have a lot of fun doing these shows, so I appreciate you guys listening, and I hope you guys enjoy it as much as I do. As always, will you please like and subscribe on Wrestling with Real Estate? It really helps me grow this channel and get better guests. And also, more importantly, if you can go on the podcast and give me a 5-star rating and write me a great review. People really look at that when they look at the show and they consider being a guest. So the more I can grow the show, the better I guess I can get on the show, and the more quality I can provide for you guys. So I would really, really appreciate it. And I've set a goal of reaching 100 5-star ratings and 100 great reviews. So if you guys can go on there, it would take you maybe 5 minutes total. I would really appreciate that. And then if you've done, reach out to me so I can thank you personally for doing that. But yeah, again, thank you for sticking around for the show, and thank you for being a listener to my show. I really appreciate each and every one of you.